Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. One of the best ways to get a pulse on what's going on in the gaming industry is by looking at results from MGM Resorts. The company has exposure to not only Las Vegas, but regional casinos in the US, and then, of course, Macau, which is the world's biggest gambling market. We know that the Las Vegas Strip is doing extremely well coming out of the pandemic, record results there, beating even the peak years of 2005, 2006. That's how good things are on the Las Vegas Strip. We also know that regional casinos have done relatively well throughout the pandemic. There hasn't been the same drop off as there was in some other parts of the world, but Macau was the big question. And late last year, China ended its zero COVID policy that allowed people to travel more, and Macau is really coming back as a result. So I want to dig through MGM's recent results and show exactly what the trends look like and what investors should think. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you like this video, check out my newsletter, Asymmetric Investing, in the show notes. And I want to just start with a couple of charts from MGM Resorts. This is the results from Vegas operations. You can see that net revenue was up slightly. These graphs are a little bit confusing because they're not quite to scale. So the increase here is only $10 million, not a big increase at all. Casino revenue was actually down slightly, 1%. That's pretty consistent with what we've seen reported in Nevada. We're starting to see at least a slight pullback from the casino revenues that we saw last year. But the good news is that table game drop, that's a measure of volume of betting at table games, that was up 5%. Hotel revenues were up 2%. And you can see here, occupancy 96%. And revenue per available room up 8%. That's just incredible performance for the Las Vegas Strip. So I think everything seems to be really going well there. On the adjusted property EBITDA side, this is going to be a proxy for cash flow coming from the casino. And you can see that results were down a little bit from a year ago. And that's going to be largely because of higher costs associated with things like higher food costs, higher labor costs. So not a huge surprise there. And a margin of 36.2%, still extremely strong in Las Vegas. Regional operations were a little bit worse. Net revenue is down 3%. You can see that casino revenue was down 7%. So obviously there is a pretty significant drop in the amount of gambling that people are doing at regional casinos. Non-gaming revenue was up 9% though, so that was a positive sign. Adjusted property EBITDA, again, $294 million, down 14% from a year ago, but over 30% margin. So that is what we like to see. I would look at specifically the regional casinos as just being a cash flow business. This is not going to be a particularly strong growth business for MGM, but if they can just keep churning out cash year after year, that's going to be positive for the company. MGM China, which is really the Macau operations, this is where we want to see the growth. And you can see that revenue was up 5% versus Q2 of 2019. So keep that in mind. This is the comparison that they're making here is 2019. This is not year over year. Not only was revenue up, but EBITDA was up $209 million in EBITDA, and margin still not quite where you'd like to see it, over 30%, but 28.3% is a pretty solid result given what we've seen in Macau over the last couple of years. So I would say across the board, really strong results from MGM. And this is pretty consistent with the improvement that we've seen across the casino industry. I mentioned earlier that the increase in revenue in Macau has been really happening since late in 2022 when the zero COVID policy ended in China. This chart really puts that into perspective. What they're showing here is the Macau market overall in this gray bar is the percentage of gross gaming revenue, GGR, as a percentage of 2019. 14% in Q4 2022, all the way up to 62% in the most recent quarter. For MGM, they're obviously outperforming, now exceeding 2019 numbers. And you can see how quickly things are growing. I would expect that as the year goes on, we're going to see even more activity as more people begin to do things. The challenge for Macau is that China's economy does not seem to be quite as strong as it was in the mid 2010s. That's when a lot of the growth was going on in Macau. But this still should be a very, very strong cash flow business for MGM. And then I also just wanted to show this chart here. Over the last decade, one of the big changes in the casino industry has been the sale of real estate assets to REITs. And the impact on the casino operators like MGM is that you have effectively a fixed cost. There's some slight increases over time for the amount of rent that you're paying each quarter, but you have a relatively fixed cost for that rent piece. So you have more operating leverage, is what it's called. So if revenue grows 10%, your costs don't go up 10%. You get to basically pocket that difference. So this shows here total cash rent that the company is paying, and you can see that it's very flat in 2023. And they give some details here that Vici lease escalates 2% per year on May 1st for the first 10 years and is capped at 3% growth thereafter. Similar terms across the board, although they're a little bit different for each casino. But this is where the upside for MGM is really if revenue, whether that's gaming revenue, hotel revenue, food and beverage revenue, if revenue is growing in excess of 2%, MGM is going to see a lot of that upside. That's going to be operating leverage, and the bottom line is likely going to grow faster than revenue. So not only is there the benefit from selling these assets and getting the cash associated with selling them to REITs, but also you have a fixed cost associated with the rent. So if revenue grows, that could be a big positive for the company. Now, MGM stock has basically been in a holding pattern, but I think right now we're starting to see some pretty good value in shares. As I'm recording, the enterprise value to EBITDA, according to Koifin, over the last 12 months is 10.6. That's a pretty reasonable multiple to pay for a company in the casino industry, especially a company that has fixed rents the way that MGM Resorts does. So things like inflation can actually be a tailwind for MGM. If prices go up and they have to raise food prices or raise hotel room prices, their costs aren't going to go up at the same rate. So I think that could actually be a tailwind for MGM as long as it doesn't destroy the economy. That's the big caveat there. And we should also see some pretty big benefits from Macau reopening. I think there's a lot of pent-up demand in that region. And then on the horizon, we also have the Japan casino. So long term, I still really like where MGM Resorts is. I think this is ultimately not that much of a growth play, but really is just a cash flow business. There's just not that many ways to grow the casino business the way that there was a couple of decades ago, but that's okay because this is going to be a great cash flow business whether the company is paying a dividend or buying back shares. So I still like MGM Resorts stock, but what do you think of the quarter? What do you think of the stock right now? Leave your comments in the comment section below. Don't forget to follow Asymmetric Investing. Thanks for watching, everybody. See you next time.